So we continue to see stronger economic growth in the US than elsewhere in the world. We see those, revisions in the US being positive, upward revisions from economists, whilst in the rest of the world that's mostly negative, actually. So the US equity market remains our main overweight. And when I talk to clients, it's also the one that people are interested in. Yeah. Certainly, for example, Asian clients that I just came back from on tour there, they look for active diversification, and it's in the US. And I think that whole question around, valuations is exaggerated in the US. Most of it you can explain by sector composition, by ROE, and frankly, valuations don't drive short-term returns.
So let's discuss that in more detail. When I look at the performance for the Dow and the Nasdaq over the last couple of days, we have two completely different stories. So I wonder, when you think about that, do you see any sort of room for a potential correction here? Are we just too focused on big tech and AI?
So people should spread their exposure. That doesn't mean flee away from IT, but also thinking about, what are the other, companies that benefit, for example, from AI. So I talk about the first derivative of AI. So it's not just chips, but it's basically those companies that use AI to their advantage. So it's automation, robotics, it's cybersecurity, it's, even medical, innovation. And then, one step further, it's the infrastructure behind it. So it is the data centers, it's the utilities, the electricity, it's the cooling, all of those kind of things. And when you do that, obviously you get a lot of exposure to AI, without really the same valuations.
So just to clarify that point, would you say that the positioning here is more bullishness on that second level of related AI business rather than the main players going into 2025?
Yeah, correct. I think it is really, and that's again what our clients are trying to do because of that concern around valuations. How can I take exposure to that trade without overpaying for that?
Let's look at one of the main points in your outlook for 25. I was particularly interested when I read that you looking at Asia, you argue, is the new world order. Tell us about that and how is that impacting the outlook for Asian equities? Yeah,
so certainly we're in a world where there is a lot of global competition, and in particular in manufacturing. So it is in the new world order around us. Each country and each bloc is trying to find its feet and its policy. So it's a lot about which are the economic blocs that are going to have a strong economic policy. The US has one, Europe doesn't, and therefore we see the problems in the manufacturing. And then in Asia, obviously, China has an industrial policy. India wants to stimulate and really go into that advanced manufacturing. What is interesting, I think, in Asia is that, which is underappreciated, I think, is that every country there is very different. The Japanese market, the Indian market, the Chinese market are very different in terms of economies, but also in terms of the sector composition. Who owns it? Is it domestic? Is it an international market? For now, obviously, in the world order where we're probably going to get more tariffs, we remain for the moment neutral on Chinese equities. We think there is going to be more stimulus, but mainly going to be able to offset that headwind rather than leading to a reacceleration. We need that reacceleration for equities to have a sustainable rally.